like to call up to the stage our panelists for this very interesting discussion. As our good Darren had mentioned, it is about neobanks, fintechs, and traditional banks who will lead Africa's future financially. If the panelists could please approach the stage. I think the four panelists know who you are. Please mic up and make your way to the stage. I will do an introduction. First on the panel is Nkaiseng Oratile Ralepele, a seasoned leader in payments, fintech, and digital assets, passionate about emerging technologies, currently the VP of Product for Digital Assets at Absa CIB. Round of applause, ladies and gentlemen. Another of our panelists is good Edmund Higginbottom. Edmund is a veteran investment banker and private capital fund manager with extensive experience across London, Johannesburg, Lagos, and Dubai. Prior to Verdant Capital, Edmund has worked at global investment banks including Deutsche Bank and Morgan Stanley. A round of applause for good Edmund. The third person on the panel is good Yonga Mpangwana Kasambara. Apologies if the pronunciation is not as exotic as it needs to be, good people. A strategic IT professional skilled at leadership in cybersecurity and IT risk management, leads the technology and cyber risk function for the home loans division within Absa Group. Round of applause, ladies and gentlemen. This panel discussion is on neobanks, fintechs, and traditional banks, and it speaks to who will lead Africa's financial future. I think for the sake of the discourse and the discussion, there will be a few questions asked of our panel members as experts. There will be a round robin afterwards, and then there will be questions invited from the audience members. For the time being, let's just jump straight into our discourse. As it relates to neobank, fintechs, and traditional banks, our good panel members, one of the things we'd like to explore over here is, let's talk about the evolving role in Africa's financial ecosystem. So a nice question that I'd like to submit to you, good Yonga, would be, how do you think neobanks, fintechs, and traditional banks are redefining their roles in Africa?
Thank you. So there's definitely an evolving of the different roles when it pertains to fintechs, neobanks, as well as traditional banks. But each one of those role players are evolving at a different speed and with various risk appetites, right, coming from an IT risk perspective. So we are seeing that fintechs and neobanks are redefining the scale, innovation, as well as access to banking for all of those unbanked groups, right, in the continent. But it's interesting because traditional banks are evolving at a much slower pace with a very deliberate focus on system stability as well as regulatory alignment.
Great, thanks for that. I think as an introspection, ladies and gentlemen, we brought up some good points on the basis of regulation, where regulation is going, how does regulation enable the actual fintech environment. And a lot of people believe that regulation could be an antagonist to actually the financial inclusion and the progress of fintech as a whole. I move on to my next esteemed panel member. And let's move on to the regulation context and innovation. So are current regulatory frameworks enabling or stifling innovation in fintech and neobanking? Over to you, my good sir.
I think it kind of depends. Because of how fragmented the different countries are across the continent especially, you don't get that synchronized sort of regulatory climate that is conducive, I guess, for trying to scale your businesses across all of those regions. We know this to be true also from a banking perspective, right? So even with the capital that a bank like Absa has, going into other regions and other markets across the continent can be incredibly cumbersome from a regulatory perspective, but also incredibly costly. So that can be the first way in which it can be really difficult. But then the second way has to really deal with whether or not those regulations are in line with the technology stack or innovation that you're trying to address. So my space, I work with blockchain technology more especially, and so across a lot of the places in which we function on the continent, you don't see the level of regulation that's needed in order to significantly boost both the investor confidence, but also the bank's confidence in launching products in those markets. And because we're a bank, right, we don't want to find ourselves in a position where we're, after the fact, penalized for launching products that were either not regulated or insufficiently regulated. And so I think, to some degree, regulation does need to catch up a lot with the innovation piece. That will open up the ability for even larger institutions like banks to actually do that. I mean, I come from startups historically before coming into a bank, so this is my first quote-unquote corporate job. And I think having worked in startups and having worked in banks, there was a perception that banks are notoriously slow to try and develop things. But because you are a regulated institution, unlike with a startup where you can afford to take off the regulators, with a bank, the consequence of that is you lose your license, right? And that's crippling for any institution. So until the regulations, I guess, catch up with the innovation that you're trying to drive, it becomes really tricky to do that.
Thank you for that, esteemed panel member. Good audience, let me ask all of you, how many of you believe that regulation stifles innovation, that it can be a problem when you are trying to pitch an idea, or if you have some sort of new initiative within business, that normally you are challenged either by governance, by compliance, or by regulation in itself? Hands up for those who believe that it does stifle. Great. So for the majority of us, we believe it might not stifle. I'd invite us to consider that when we look at AI as an example of the progress of technology, we are sitting in a kind of a segue where the change of technology and the proportional change to regulation doesn't synchronize very, very well. So those are some good points which were brought up. Indeed, there is a need for our regulations to catch up with our technological ambitions. All right, good people, let's move on a question regarding financial inclusion and who is really making the impact. My question that I'm posing to you, my good sir, is that which of the three contributing banks, and I'd rather not go with respect to three individual brands, so let me reshape that. How are digital finance service addressing, and services as a whole, addressing the rural-urban financial divide?
My name's Ed Higginbottom. I'm the managing director of Verdant Capital. We're a mezzanine fund. We invest in financial inclusion and digital finance and alternate credit. We need to look as an ecosystem, and ourselves as an investor, we need to look to support new innovative businesses which address gaps in the market in the financial sector. And if we look at the continent and we look at rural areas within the continent, there have been and continue to be significant challenges providing financial solutions to low-income groups, rural areas, dispersed populations. All financial services, one way or the other, are commission businesses. They're based on the size of the transaction or the size of the financial service, the size of the payment, the size of the loan, the size of the deposit. It's all one way or the other. It's a percentage of the volumes concerned. So when we start dealing with very low-income groups, low-income individuals, we look at small businesses, micro businesses, the numbers are much smaller, whether it's insurance or payments or credit or any other financial service. So the opportunity to make money is small. You then layer on other challenges, dispersed population, physical infrastructure, communications infrastructure. It's harder to reach those people. So you create a segment of the continent, you create a segment of South Africa where you have underbanked and underserved consumers. It's just very hard to make money out of them. So what's changed? If we look at the last 15 years, there's been quite a profound change in technology that has enabled services to be provided to that lower end of the economy, that more dispersed end of the economy, that hard to serve economy. Those changes in technology have enabled businesses to serve those people effectively. So some people call those businesses Fintechs. It's a term that we maybe recoil against a little bit because it's a bit of a cliche and it covers a multitude of different things. But financial services companies who leverage these changes in technology. So what are these changes in technology? Mobile wallets. So perhaps less prevalent in South Africa because by law we have universal service obligations which compel banks to provide bank accounts. Elsewhere in the world, elsewhere in Africa, we don't have that type of legislation. So mobile wallets, providing in effect a bank account to people who are, in inverted commas, unbanked. Mobile payments. We have ability to collect and aggregate data, different types of data on small customers. So we can collect payment data, we can collect social screening data, alternate data on small customers. In the past, it was impossible to identify and collect data on individuals of low income and micro businesses. We can now collect that data. We can analyze that data. We can analyze that data more cheaply, including technology, things like machine learning and dare I say it, AI is another overused expression. We've got ways of tracking technology, tracking assets for financing. We've got ways of embedding finance in credit in overall financial transactions. We have things like cloud computing. We think of that as standard today. 15 years ago, it wasn't. Small businesses had servers, had server rooms. So we can now provide credit, insurance, different types of payments, deposit mobilization to people in rural areas, and we can do that profitably. Companies can do that profitably. And those businesses have been successful raising capital. Some of them have gone on to do very, very well. Some of them have crashed. Some of them, perhaps a little bit more opportunistic and, Me Too businesses which also crashed. It's beholden on us as an investor, it's beholden on us as other investors to look at these opportunities and make money for our own investors, for our own clients.
I think you raised some exceptional points, but especially highlighting the fact that we talked about regulation. You went on to infrastructure, you went on to the need for selective process of ensuring that we nurture innovation. Brilliant points, because sometimes our intention might be there with respect to progress on the fintech side, but we don't have the commensurate infrastructure to facilitate that intention. So acknowledged, great. Thank you for that insights. Let's move on to our next question, Madam Yonga. So let's talk about trust. Given the fact that we understand that your expertise extends into the banking environment, my question to you is, are consumers more likely to trust traditional banks over newer digital players?
So the thing is with trust, it's earned over a period of time, but it can also be lost within seconds, if not milliseconds. With traditional banks, they rely mostly, or they benefit from institutional trust. Whereas with the fintechs and the neobanks, they kind of have to prove themselves in order to earn that trust. And I believe how they can actually do that is through robust processes, especially in the cybersecurity space, with all of the cybersecurity threats that are coming up, in our financial ecosystem.
I must acknowledge that that moving into the cybersecurity narrative is a very astute and good observation when it comes down to the element of trust. Mm-hmm. That's one of the mechanisms in which banks and fintech equivalent organizations can protect their reputation and thus nurture and ensure trust. So I acknowledge, good Yonga. Thank you for that. I think in the interest of us progressing our conversation, Let's move on to our next question and our next esteemed panel member on funding, scalability, and sustainability. A question I pose is, how are fintechs and neobanks raising capital and scaling in African markets? What would you see as your insights and observations? And do you have any recommendations with respect to that? I think you are most certainly right. With respect to mezzanine finance and your experience in those diverse markets, Edmund, this bait and toss is to you.
Capital markets are fundamentally very, very cyclical. And without being too philosophical, the biggest challenge to the capitalist system is, ever since the days of Marx and all the original critique of that system, is cyclicality. It's cyclicality in the real economy, it's cyclicality in the capital market. And the opportunity in terms of disrupting the financial sector, in terms of leveraging technology to include people, unbanked people, underserved people into the financial economy, that opportunity is real. And these businesses many of them are very profitable. These businesses have a great potential to be profitable. But ultimately, the venture market, the fintech market for investing in fintechs has been incredibly cyclical. So in 2021, in 2022, in 2020, you had companies who were raising big amounts of money with just a pitch book, with just PowerPoint slides. You had companies who were with, businesses which were wafer thin, with very concentrated customer bases, with significant regulatory risk, with minimal proof points, were raising money at 10 times revenue, 20 times revenue. So we had a boom in fintech, we had a bubble in fintech, and a lot of very, 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 very bad companies raised a lot of money. A lot of good companies, very good companies, raised money as well, but a lot of very bad companies raised money, and a lot of those companies have crashed and burned in 2023, 24, 25. A lot of, and unfortunately, a lot of good companies have, we've had a venture winter. We've almost got a fintech winter at the moment. It's much harder to raise funding as a fintech in the venture market than any time in the probably last 7 years. And, while a lot of the bad companies have crashed and burned, we've got a lot of companies who are good, who are very good, who are battling to raise funding in the current environment. And my advice to entrepreneurs who are some of the good guys who are finding it more difficult in this environment, my advice is twofold. So firstly, be careful how you spend money. Businesses who lose money don't have a God-given right to raise money every year, to raise other people's money to grow their dreams and their visions. Focus on making money. Focus on if you've got customers, if you've got revenue. Look at your cost base. Make sure you can survive 24, 36 months without new money. The second piece of advice I'd say is be a lot more thoughtful about capital solutions. If you need money in the next 12 months, next 24 months, don't be fixated on the next letter in the alphabet. If don't be fixated on your B round, don't be fixated on your C round. If you've done a seed round, don't be fixated on your A round. Think about different capital solutions. If you're profitable, should you be bringing in debt funding? If you've got balance sheet, if you've got a credit book or payments float, should you be looking to bring in debt funding to fund that part of that balance sheet? Should you be looking at venture debt or mezzanine? Should you be looking at corporates? Should you be looking at a corporate minority investor? Or should you be looking to exit the business? If you've got a good product that will work for somebody else, there's exits in advance of being a unicorn. You don't have to be a unicorn to exit. You can look at bringing in a corporate partner and transition the ownership.
Very insightful commentary. Thank you for that. Good, Edmund. I think back to our esteemed second speaker on the banking expert side. Partnerships between fintechs and traditional banks. Talk to me on your opinion with respect to are partnerships between traditional banks and fintechs the future of African banking? What do you see as the positives, negatives, pros, and cons to that statement?
So I think there's a place for partnerships, right, between those two particular segments of the economy. And I think banks have a crucial role to play beyond just sort of that technology partnership, but also capital injection to those fintechs, where it's best placed to provide that capital injection. I think you are going to see the proliferation of that relationship between fintechs and banking partners with the success of companies like M-Pesa at scale. But you know, that relationship is contingent on the successes that Edmund was also describing just now. The reality is that there are enough bad actors within the fintech landscape who might put off that strategic partnership in the long run. That's not universal, obviously, and it's specific to industries, but that's one of the things that we cared very deeply about, right? That's why we have such robust processes in identifying who to make those strategic partnerships with from a banking fintech perspective. But I also do think that it's good that there's competition between the two. So sure, like where needed, that partnership needs to be there, but as a capitalist, I'm super big on that competition also being there, right? So banks should be in a position to wake up and understand when it is that they need to innovate internally and when it is that they need to innovate through partnerships or through acquisitions or anything along those lines. And so I think, you know, to answer your question on whether or not it's the future of what banking will look like, I don't think that that's what the future will look like. I do think you will have more strategic partnerships, but to own the life cycle of a customer, you probably want to contain that as a banking institution broadly, as opposed to letting a lot of that revenue go into, you know, fintech pockets. Where we don't have the choice to do so, we'll probably have to revisit that. So if you look at the UK, for instance, and Europe with open banking, where banks had to open up to fintechs, that's not necessarily the case here. You might have regulators trying to push for that in South Africa more specifically, but I don't think that's going to happen anytime soon, realistically speaking. So I think on the continent, you'll have that balance between when it is valuable for you as a banking institution to have that strategic partnership and when it is that it's not. And finally, again, as I mentioned before, the problem with a financial institution or a bank more broadly is that the strategic partnership you have with a fintech, they rely on your banking license, right? That's why they want that strategic partnership to begin with. And so you have to be very careful about who it is that you select, because a bad actor on the fintech realm will ultimately mean you are held accountable by the regulator should something go wrong. So there are some of those considerations around what that partnership might look like down the line.
Good audience members, I think with respect to the insights which have been shared, there's quite a diverse opinionation. We have the banking sector, we have fintechs, we have the exploration of strategic venture capital financing. I must say this has been a very productive exchange, and I'm going to invite each one of our panel members to have a concluding note before calling the panel to a close. Over to you, Yonka.
Thank you. So my closing note, I'm going to lean more on the question that you just asked, on whether we're going to see more competition or collaboration between the traditional banks, neobanks, and fintechs. And I will have to disagree to some point with my fellow panelists. I do have a different view when it comes to collaboration, and I do believe that the market is pushing the traditional banks, fintechs, and the neobanks to work closely together. More so when you look at banking as a service models, right? Digital banking. All of these different parties actually bring different things to the table that each of them can actually benefit from. Going back to the question about trust, right? We spoke about the institutional trust that the bank offers, But over and above that, the traditional banks also bring about the regulatory know-how, the infrastructure. I think we had a point about the infrastructure and the need for infrastructure when it comes to the fintechs and the neobanks. And on the other hand, the fintechs and the neobanks bring about the innovation, the scalability, and the reach that we are trying to get from a traditional bank perspective. So I do think that the future does look like that, where these three parties are actually going to be forced to collaborate and not really compete, but take from each other to really create an ecosystem that is not only chasing innovation, but is also closing the gaps that we often see from the fintechs and the neobanks when it comes to regulation, right, and from a risk perspective. Thank you.
I think the scenario that she's just described is contingent on the word force being at play. So it is true that if you look at countries like the UK, or you look at PIX in Brazil, or you look at ADA in India, there was a regulatory push by the government that forced fintechs and banks to collaborate. The underlying premise of the context in which she's talking about, I think, is contingent on that regulatory nudging and pushing being in place. And my position is that I don't think that South African regulators at the moment are going to necessarily force banks anytime soon to open up those open banking-esque platforms, or even construct the infrastructure needed for open banking integration that you saw in the UK and the EU. And that's why that collaboration was there. And I don't think, unless you have that regulatory push, banks are in a position to ever say, I will willingly give you my data. And ultimately, we sit with a rich amount of data that could be leveraged by these fintechs, right? That was why fintechs in the UK, in the EU, were trying to push aggressively for banks opening up their data so that they can consume that data, clean it, and then use it to build things like VRPs. And I don't think until such a time that you have that significant mandate that's being pushed by a regulator to force financial institutions to do so, you'll probably have that. To that end, then, you are then going to continue to have, I think, the kinds of collaboration that you're having right now, where it's very selective in who it is that you ultimately try and partner up with, because you, on the negotiation table, tend to have both the capital and the data unique there. It is true that some fintech providers, and I agree, are providing very valuable services that banks should be intentional about trying to provide for their end users. So I do think to some point that collaboration will still be there, and we'll probably start seeing an aggressive implementation of that strategically across different banks. But I don't think it'll be at the scale in which you saw in other countries that I mentioned before, just because there was a regulatory mandate there and there isn't here with us.
One comment I'd make is we continue to believe that the biggest opportunity in financial services in fintech in Africa is credit. We've got, as an economy, as a continent, most countries in the continent have private sector credit to GDP ratios of between 1.25 and 1/2, i.e. aggregate GDP, aggregate income of the country. The actual stock of credit to the private sector is between 1/4 and 1/2 of national income each year. Everywhere else in the world, it's 1 times, 1.5 times, 2 times. And that's a major drag on the ability of the economy to grow and to create more consumption, create better businesses, build businesses, buy long-term assets for consumers, houses, cars, etc. And credit's a dual-edged blade as a business. You can make money, but you can also lose money as a credit provider. If people don't pay back, you lose money. So the opportunity for us as an ecosystem, as a fintech ecosystem, us as investors into that fintech ecosystem, I think is the interesting players who are intermediating credit, who are providing credit to the real economy in different ways, different solutions, different ways to manage the risk, manage the costs. And I think we're at a very, very early stage. I think we've had this fintech theme, this fintech story, the last 5, 7, 10 years, but we're still at a very, very early stage of growing private sector credit to the real economy.
Ladies and gentlemen of the audience, I think we have time for just one or two questions. If there are any burning questions at this point in time, hands up, please.
I hate the sound of my voice, but never mind. I'm a registered professional banker, plus I'm a crypto analyst. And I'm actually giving an answer, I'm not actually asking a question, but an answer. Because the crypto industry is growing at such a rate, especially with the Trump administration, it's opened up everything. The main problem at the current moment, is people's hiding, sitting on their bums, and not thinking about the future to do with cryptocurrency, because it's going into the banking space, whether they like it or not. And secondly, education is the biggest deal now to get people involved with cryptocurrency, to understand it, because cryptocurrency is not a scam. It's not what people think it is. If you understand exactly know what you're doing, it's like equity. If you understand equity, you can invest in equity. The same with cryptocurrency. And cryptocurrency will also serve the underbanked, because if you got bad credit, you can't have a bank account. You can only have a savings account. Whereas with crypto, you don't have debits. You only have value and credits. So you can be involved with that system. And transaction purpose, you can transfer money from a phone to another phone via blockchain. That's it. You don't need a bank. You don't need to rely on a bank. But I know in practice, the Reserve Bank controls the money supply of that country or the world, like the US controls the US dollar. So in a way, there will have to be cohesion between the banks, crypto, and equity.
I think let's be fair to the banks here. Every bank that I know has a dedicated blockchain digital assets team. I just want to be careful about some of the wording here, because the underlying technology, the blockchain piece, I think is more palatable for people to understand. The value-added stuff, like the crypto stuff, is where the trickiness sometimes tends to be. I think you can also admit that the proliferation of SHIT coins, right, is not a good look for the industry. I think because they happen at such a proliferated rate, I don't think you're going to have banks adopt cryptocurrency at scale like that. I do think for Bitcoin and Ethereum, that's an easier sell for people to understand. So that's the first piece around the distinction there. The second one is, it's all well and good to think that the regulators is just going to let capital leave the country just like that. That's never going to happen at scale. So it's happening right now because the volumes aren't big enough for the regulators to care. When the volumes become substantial, the regulator will care. You will be punished. And so if you're a registered entity, you need to be careful around things like KYC. And that speaks to some of the stuff that you mentioned around, you don't need a bank account or an identity document. That will fall away when the industry becomes regulated, because any financial institution or CASP has to do KYC on that clientele. So some of the stuff that the crypto space speaks about can be lost in translation in the pursuit of regulation, because you want the legitimization by those specific regulators. But that's going to come at an opportunity cost with the tech stack itself. And so my team specifically looks at tokenization of equities, looks at stablecoin usage for things like international payments. So we just need to, I guess, be careful around some of those nuances around crypto, because unlike with a traditional account-to-account payment, you can't go to a bank account. So in those rural areas that you're saying crypto will be really beneficial for, those people will not be able to go to a bank account and say, I've been scammed, because you are going to have to rely on that counterparty being willing to send you back that crypto. And so there are some dangers there that are unique and embedded in the technology stack that we need to be careful of. And I say this as someone who's been in the space for 8 years, right? So I would just caution against the idea that crypto solves everything.
No, I never said it solves, but but it's a whole new thing at the moment. and people don't understand it fully. If you don't understand it, you can't go into it. Education is the biggest problem, and knowledge of it. Like, I'll give you an example. If you invest in a company, you read the company prospectus. If you invest in a certain blockchain, like Ripple, or Bitcoin, or Ethereum, they all work on a different blockchain. You read the white paper of that blockchain so that you can actually see what direction that blockchain is going, who's investing in, how the mining protocol works, how the circulating supply of that blockchain will work. This is what I'm getting at.
I try not to conflate blockchain and crypto completely. I think blockchain is a very interesting technology. The biggest application has been cryptocurrencies, but it has many other applications other than cryptocurrencies. So I keep the 2 points separate. I think if there was 2 words to explain cryptocurrencies, the 2 words I would choose is regulatory arbitrage. You have a shadow currency that falls largely outside the regulatory net, and that can be very, very helpful for businesses. In the 1980s in South Africa, people bought empty shipping containers, shipped them to Germany, sold them for Deutschmarks, and they did that because they couldn't convert their rand into dollars or Deutschmark or pounds in any other ways. Today in Nigeria, or during the worst currency controls in Nigeria in 2022, 2023, and 2021, Nigerians were selling Naira, buying Bitcoin. They didn't want Bitcoin, although maybe some of them did want Bitcoin, but they were selling Bitcoin then to get dollars. So crypto is a great way of arbitraging your way around FX controls, or can be a good way of arbitraging around exchange controls. But it's also a way of getting around other regulation, which is important. It's a way of getting around KYC and anti-money laundering and anti-terrorist financing, and a lot of the things which the banking sector has clamped down on over the last 20 years. It's clamped down on kleptocrats putting money in Switzerland. It's clamped down on terrorist financing. The US started to have money laundering controls and regulation and enforcement after September 11. Before then, it was somebody else's problem, and they were happy making money. So we've done a lot of work's gone into regulation, which is fundamentally a public good, and crypto coin gets around regulation that's not a public good. Currency controls are bad for everyone, but it also gets around regulation that's a public good. I think we've all got to be conscious that crypto coin is a two-edged blade.
Yeah. But you see, you determine between centralized and decentralized control. With decentralized control, you control your seed phrase. With centralized, it's controlled by that entity.
No, I agree.
And I agree, legislation is a major concern because people don't actually know how it works. The banks don't know how it works. Individuals don't know how it works. It's a whole new thing at the moment. But if all 3 players can work together, they can benefit. But the banks, I'm a banker, so I can also say, because I am a banker, the banks don't like competition, but they're going to be forced to comply with competition, and crypto is one of those that's going to be in the competition field. Whether they like it or not, they have to grow with the process and include themselves with crypto and equity in that process. Because NFT, you can also create lending and borrowing protocols on the NFT via the fractionalization process. NFT is not just arts and music, it's much more than that. That's the next big thing of crypto that's going to enter the space.
I don't disagree that it's important. I do disagree fundamentally that I think you're underplaying the investments banks already have in the space. JP Morgan, Deutsche Bank, HSBC, ABSA, FNB, these are all products that currently exist that pertain to either the underlying blockchain technology for treasury management or the facilitation of movement of funds from one country to another, even though they might not call it a cryptocurrency. So I don't think banks are sitting idly by and watching things happen, or they don't fundamentally understand what's going on. JP Morgan has a 400 plus strong personnel of people, $13 billion of inflows into South Africa using stablecoins last year alone. That's going somewhere, right? Like fintech providers don't on and off ramp you. that is done by a deposit-taking institution, in which case it is a bank. So I don't believe that banks are just sitting idly by and not doing anything about it.
No,
Otherwise,
not all banks, but it's because they don't understand it fully. It's human nature. People don't want to change. It's human nature. And technology is going to force them to change.
Good people of the audience,
Yeah.
I allowed the dialogue to continue because it segued into a very, very interesting commodity so far as fintech is concerned, cryptocurrency and the elements regarding that. I love the fact that we have viewpoints with respect to that. It is important for us to delve into that, extract true context and true value from it. I see that there are experts in the audience which are passionate, which I feel very, very happy about. Needless to say, you can consult with some of these experts as well. I want to thank our panel members for their very esteemed and corporate look into this, this particular dialogue. Good Sir Edmund, good Sir Nkaiseng, and good Madam Yonga. Thank you for your contribution to this discussion. Round of applause, ladies and gentlemen.